Welcome to The Explainer. Today, we're digging into the latest financial results from real estate company Goodland Group. And let me tell you, it is quite a story. A really dramatic swing from a big loss to a solid profit.
All right, let's just jump right into the headline number because it really sets the whole scene. Goodland Group completely flipped its fortunes. They went from a $2.3 million pre-tax loss in 2024 to a $1.6 million pre-tax profit in 2025. I mean, that's a nearly $4 million swing in the right direction. That is a stunning turnaround, no matter how you look at it.
But here's where it gets really interesting, because this turnaround comes with a puzzle. You see, this impressive profit wasn't driven by sales going through the roof, which is what you'd normally expect, right? Nope. The story here is actually a lot more complicated than that.
In fact, if you just look at their top-line numbers, their sales, they actually dropped. A lot. So you've got to ask the question, how is that even possible? How do you end up making more money when you're bringing in less cash from your main business?
And when you look at the numbers, it's a pretty steep drop. Their total revenue fell by over 40%. It went from $10.7 million in 2024 all the way down to just $6.1 million in 2025. I mean, that's a huge dip, the kind of thing that would usually spell big trouble.
So why the big drop? Well, according to the company's own report, it's mainly because they recognize less revenue from their development projects this year. So in simple terms, it's all about timing. The pace of their big construction projects meant that less cash from finished sales actually hit the books this year compared to last year.
So here's the real secret sauce. The path to profitability for Goodland wasn't about growing sales. Not at all. It was a really clever combination of cutting costs and boosting other income streams that weren't related to sales. This is where the real story is.
And this table, it tells you everything you need to know in one quick look. You can see that big revenue drop right there at the top, but then look below it. A huge 46% jump in what they call other income, and a sharp 30% cut in administrative costs. Those two moves right there were so powerful, they completely wiped out the sales decline and pushed the company back into the black.
So the real hero of this financial story is that other income line. It jumped by almost $2 million. Now, this wasn't from selling new condos. It was mostly because the value of their existing investment properties, the buildings they already own, went up on paper. Think of it like your own house increasing in value. It makes you wealthier, and for a company, that can count as income.
And while that was happening, the company was also seriously tightening its belt. They managed to slash over $1 million in just day-to-day operating costs. We're talking about savings on everything from salaries and employee benefits to maintenance and property upkeep. It was a really serious and obviously successful effort to control their spending.
Okay, so that explains how they managed to turn a profit. But does that mean the company is actually, healthy? To figure that out, we need to look at the balance sheet and see what the bigger picture looks like.
And whoa, okay, the first thing that just jumps right off the page is this massive $18 million increase in properties that are currently under development. So this tells us they are investing, and investing heavily in building for the future. So you might be wondering, where'd they get the cash for all that new construction? Well, this slide gives you the answer. To fund that growth, the company took on an additional $15.4 million in bank loans. So the strategy here is pretty straightforward when you put those two pieces together. Goodland is actively and aggressively investing in new projects, and they're using borrowed money, debt, to pay for that growth. They're betting on the future.
So they're investing more, they're borrowing more. What do they think is going to happen next? I mean, how do they feel about the market they're borrowing all this money to build in?
Well, if we look at Malaysia, which is one of their key markets, they're expecting to see moderate, steady growth. They're betting that strong local demand, some helpful government policies, and stable interest rates will keep things moving in the right direction. And then back home in Singapore, the story's pretty similar. Official data is pointing to a slow but steady increase in property prices. It's not a boom, but it is a consistent positive trend, and that's exactly what a developer wants to see when they're investing. So when you put all that together, you get their official company line. They're feeling cautiously optimistic. The game plan is to be really selective about which new projects they start, all while keeping that super close eye on costs that work so well for them this year.
And that really leaves us with the big million-dollar question. Goodland is taking on a lot more debt to expand in a market that they themselves describe as only moderately growing. So is this a bold, brilliant strategy for future growth that's going to pay off big time? Or is it a high-stakes gamble? That is the crucial question for anyone watching Goodland Group from here on out.